What I appreciate and look for dissecting what Adam did here is, hey, they have their neighborhoods they focus off. They have their buy box into the areas and the prices that work for them. And you see great deal makers like Adam. What I have noticed is they all have patience. Like, hey, here's the numbers. If it doesn't work away, hey, sorry, it doesn't work, right? Live underwriting deal session on a 65 unit luxury development in Wash Park. I've got a great crew I'll introduce here in 3 minutes to walk us through. But very excited to use this to kick off a show we used to do a lot, which is our weekly deal analysis. Since we got this deal and a few other deals we're underwriting here, want to revive and use this to kick off our new show, The Deal Room, Real Estate by the Numbers. We're just going to go through and talk about real deals that make sense in 2025. So now a lot of you guys are plugged into our portfolio analysis mastermind, which is all about you understanding your portfolio and then learning about the opportunities that make sense in 2025. As I've said in the past, the old playbook is broken. We have to learn the new playbook. This is a new playbook, and this deal underwriting day is part of that new playbook. So I did go through 10 opportunities on there that make sense. And this 65 unit, it's really focused on what I call 6 and 7 here. Hey, great opportunity in multifamily right now, and especially commercial multifamily, so apartment buildings with where the market cycle is, and for new investments, and at the same time for many landlords, like myself and many on the show here who have a large portfolio and trying to figure out the next portfolio moves. Good opportunity as well to go from active investing to passive investing by investing in bigger deals like this. Quick disclaimer on here: we are showing a live deal. We are doing this, for education reasons. We have a lot of people that want to learn about this, but understand that investing always involves risk. We are not soliciting it. We're not doing an investment offering on here, but we do want to use a live deal so people can see what the market is in. Now, with that said, this is a deal I have personally invested in. And also our group, Property Llama Capital, has also partnered to help bring investors and raise capital for the deal. And we're using this because a lot of investors who are investing in this deal are interested and doing this as part of their due diligence, which is so vital for any investment you do. The second thing, as I go through and look at these deals myself and put together deals, invest, I'm like, wow, this is just the best stuff to go out there and underwrite and learn about. And so I wanted to share it as well with our deal show because so many people are interested in development underwriting and also investing in deals like this. So please use that as educational. Now, with that said, I want to introduce my first co-host, Christy Burkowski. She is an investor in this deal. She has an active landlord with rentals, shifting more towards passive. And she also has a personal passion for learning, development, and underwriting. Good morning, Christy.
Good morning, Chris.
Glad to have you on here. And the man in the spotlight, we got Mr. Adam Fenton with Narrate Holdings on here. So he is the founder of Narrate Holdings and also the developer taking the lead on this project. And so we'll be diving into this 1000 South Logan. And Adam, I love talking development. I love talking spreadsheets with you. I'm excited.
Hey, thanks for having me. Another one here, and a little deeper dive than we went last time. So ready to dive in.
Cool. Well, let's start. If you can pull up your spreadsheet, we'll start sharing screens here. While Adam does that, everyone in the chat, if you got questions, feel free to ping us in the chat. We are monitoring those, and we will be doing live deal underwriting on here as well. So put your questions in the chat, and then Christy and I will be moderating it.
All right. Can you see my screen?
We can. So we assume a lot of people have listened to the podcast or the overview we talked about, but we're going to dive straight into the number. So Adam, I would love to start on here and just talk about, from a number standpoint, the acquisition, right? Let's just start from acquisition through the business plan. So can you zoom in to kind of like the acquisition numbers and a quick story on how you acquired this property?
Yeah, sure. So anything that's in blue, typically in our spreadsheet, is editable. Anything in black, don't touch. It's sacred, and we'll probably blow the whole model up. But so you can see right here, we purchased the site for $4,125,000 back in December of 2023. So we've owned the land about a year now. And so the acquisition story here is we looked, we're active in this neighborhood, in the Platt Park neighborhood. And we actually own two properties less than a quarter mile away across the highway on I-25 there, called the Aston and Caraway. The Aston is a 73 unit project that delivered May of 2023. And Caraway is a 42 unit that we delivered over there it was January of 2023. So we love these small neighborhoods, these small boutique buildings, huge barriers to entry. We were fortunate enough to purchase this site, which is about 29,000 square feet. Sites like that just are really, really hard to come by. So it's a site that a different developer originally had purchased and had went through the process with the city, and ultimately decided he didn't want to go vertical with it. Really, development wasn't his thing. He was more a value add guy. I think he got into it and realized, hey, this is it's really hard to do. It's really hard to do by yourself as a first-time developer, a project of this size. So we started speaking. Ultimately, couldn't come to any sort of joint venture agreement, and so he decided he was going to take it to market. And they started at 6.8 million. And this, went on for about a year. And every once in a while, it would ratchet down a little bit, ratchet down a little bit, ratchet down. And they finally said, hey, submit an offer that where it works for you guys. So we submitted an offer at $4 million and didn't think that there'd be any chance we would get it. We were told, hey, thanks, but no thanks. So we sat around it was like almost 6 months, I think. And we randomly get a call from the broker one Friday afternoon. And he said, hey, seller is looking to make a deal, knows you guys can execute. So if you can get to 4.1 million, then we think the deal is yours. So we said, hey, we'll offer 4.125. We really didn't think we'd probably have a shot at getting it. So we send the contract back in, and at that point, and then we woke up next morning to a congratulations, you're under contract email. So that's kind of so it was really one of those things where we were pretty steadfast in what would work for us here, and knew we couldn't go above where we were at, and just stuck there, and ultimately the deal came back around. And we ended up closing. I think that was around August, and we ended up closing December. A little over a year ago now.
And I want to highlight here because hey, some people invest in deals like this. A lot of people do their own deals. What I appreciate and look for dissecting what Adam did here is, hey, they have their neighborhoods they focus on. They have their buy box into the areas and the prices that work for them. And you see, great deal makers like Adam, what I have noticed is they all have patience. Like, hey, here's the numbers. If it doesn't work away, hey, sorry, it doesn't work, right? And so hopefully you guys are taking that, hey, strong buy box, strong neighborhood awareness and track record in there, along with the ability to be patient. And that's how you are able to get great deals like this. Yep.
I think that's important. I've not done that before, and was just too eager to buy a property, and it's still a headache to this day. It's a deal that's going to work out, but I think you hit the nail on the head there. That's really, really important, is to have that discipline.
So looking at this here, okay, so we got the site acquired, 4.125. When you're underwriting and kind of like the business plan, like what's the next set of numbers you're putting together? Is this like this total use box here, or?
Yeah. So everything else in this use box here is really generated somewhere else. And I should say we continue to tweak this. We're in the process of, we won't tweak this, but this worksheet here, but we're always tweaking. We're always trying to make it better. And I think the thing about pro formas just in general and spreadsheets is, for us, like we'll do deals with family offices, institutions as well. So we have to have a model that is sophisticated enough for them, but we also don't want to make it overly complicated where you can't, I've seen spreadsheets before too, where it's like, you don't know where to enter stuff. You can't find your way around. And then it's like, from a return perspective, you're all over the board and you can't really figure out what the numbers are. It's almost like they're trying to confuse you a little bit. So we try to find that good balance of having enough information and sophisticated enough, but also keeping it simple, right? Because I mean, real estate at the end of the day, yes, the returns are simple, and then there's just a handful of inputs that you input. So we try not to overcomplicate things.
Great, that makes sense. So should we just start like hard cost and go down?
Yeah. So really, what I do, so we come in, you put the land in here. So then what we do next is we'll go to the revenue summary page. So let me zoom in on this page a little bit, and this will evolve over time. So when we first underwrite a deal, right, we'll have really kind of just one. We'll have one, really one unit type, one unit count, and then a rent. And then as time goes on, we continue to build this out. So when we're said and done, and are at 100% CDs, right, we'll have actually a separate spreadsheet outside of this where we'll have every single unit that we'll put a rent on. So you kind of start high level, and then as time goes on, you kind of funnel it down and get in granular detail for sure. So, but this is really where it is. So we have our affordable units here, we have our 1-bedroom units here, and then we have our 2-bedroom units here. And then that kind of goes up, and then that's summarized in a table up here. So that's kind of where we start. And the reason I go here, kind of at the start, is to be able to work. Everything else after this is kind of based upon the rentable square footage or the gross square footage of the project. Our hard costs, a lot of different things are based off of that. Our expenses. So that I always like to go in kind of initially and build out the rent schedule here. And like I said, as time goes on, we'll have every single we'll have 65 different rents on a different spreadsheet that then flows into will flow into this, which then flows into this. And then the other thing here too is we've got other income. So, and this always gets more detailed. We've done enough deals at this point in time. We know very, very high level what it's going to look like. So that's where just from doing enough projects. So but as time goes on, we do whittle that down as well. Like for example, with storage rental, right? We know generally speaking, it's about, you want to hit about 33%. So we kind of start there, but then as time goes on, we'll make adjustments for sizes, revenue generated off all of those different type of things. So really, I would say a pro forma is an evolution, over time up until the point in time where you're really ready to go, you're really ready to build a project. You're kind of tweaking and tinkering the whole time. And, what our goal is to get all the major assumptions close to right, so that as things do start refining, that we're not too far off basis. And we try to be conservative, initially out of the gate as well.
Can if you go back to that tab, I want to highlight dive into the rent study, because I mean, whether you're doing a development deal, a value add deal, or any type, like one of the most important and often areas that people don't do well on is like the projected rent. The scenarios on there. Can you spend a minute to just kind of talk about how you do a rent study? Because I mean, if you're off by $200 every unit, deal in general, man, it kills the deal.
It can be a challenge. So there's two different approaches that you take, and we are pretty lucky. We have the good fortune of having a direct competitor that we built across, really kind of a direct competitor, right? Very similar type property we built across the street, so we know the insides and outs of that rent roll. So that's going to be your best. If you can get direct comp from the property owner, that's going to be the big, that is the best, right? So I know what our 1-bedrooms that are 800 square feet are doing. I know what our 1-bedrooms that are 750 square feet. I know what our 2-bedrooms are doing. So I have that firsthand information and knowledge. So we had a little insider information on this one. So unlike stock trading, insider information when it comes to real estate is allowed and highly recommended. So that's really so that's number one. And then number two is going to be there's publications out there. There's CoStars, which does cost money. There's another one called Hello Data that is new to us. Really, really interesting though. So it's it's an AI software. We're in a trial version right now, but really, really cool. And that's pulling from like all the public stuff. And then the last thing we like to do is, look at our competitive set and really, make phone calls, right? A lot of times what's advertised online isn't necessarily what they're actually willing to do. So, it's really identifying who is in your competitive set, and then based off of that, coming up with a rent study, making adjustments up or down based on location, quality, size of project, amenity package, right? There's a lot of different things that go into that. But we had the good fortune of building across the street, and honestly, our project, the Aston across the street, was really our base case for this project. And as you see, we don't have any studios in here, and that's by design. Over at the Aston, which happy to share with anyone who's interested in it. I put together a rent study on why we outperformed the marketplace, and we outperformed our in-place rents with $347 a square foot. Our competitive set was right around $283 a square foot. And that can be a little bit challenging too if you're building a product type that doesn't really exist in the marketplace. With the Aston, we were pretty convinced that to build a nicer boutique project, but at the end of the day, it wasn't proven. But that was a different market cycle as well. So some different fundamentals there. But really, our large one bedrooms over at the Aston did phenomenally well. They, believe it or not, and when I say large, I'm talking 850 to 925 square feet. That's what I mean when I say large. And those were our first stacks to lease up, and they also were our highest per square foot rents in the entire building, even higher than our smaller 525 to 550 square foot units. So looking at it, if I could have redone Aston again, I would have done more large one bedrooms. So that's really the business plan behind this project, is large one bedrooms with a small percentage of two bedrooms.
Because the vast majority, like 50 or 51 units, going to be the one bedrooms.
That's correct. Yeah.
Awesome. Yeah, no, thank you for diving into that. I just wanted to highlight that because, I've made the mistake as an investor, and that's one of the things I always tell other people. It's like, man, know your rents, and you got to know the market, call it, walk it. But like that is usually one of the things that will make or break people's business plan.
Yep.
Right.
And the other thing I should say too, Chris, that we do, and I'd highly recommend, is to get a property management company involved. Operations company, and you have to have, you want to make sure that you're matching the right company with the right asset type as well. As an example, over at Aston, right? Like, we talked to property management companies that didn't believe that we could get the rents we got, and that's not someone that we would want managing our property for us. So we always will go back to property management to just make sure that we're within line as well, and we're ultimately going to hire one of them, so they want to make sure that they can hit whatever projections they're putting out there as well. So we'll do that for rent and expenses both. So that's another step that we go through, and I would highly recommend, if anyone's thinking about developing something, is get outside information from market experts, because sometimes we can start believing our own BS sometimes too. So you want to make sure you don't get too far down the road with that.
All right, so we got the revenue side down. What's
revenue
the next
side here?
Yeah, what's the next side of the underwriting model? You were going somewhere, you're clicking somewhere, and I steered back to rent studies.
Yep. So just back to here. So then, we typically don't put our, like this one, we do have a land loan, but it's covering itself. So that's really not a cost to the project at all. So we don't have anything in here. Then you start going through your, I actually kind of bounce around a little bit. So I would come down here and put my hard cost information and my parking information. So, and at the end of the day, You put your parking assumptions in here, you put your parking costs here, right? So we're below grade. Our parking is going to be more expensive. So we're 65,000 a door. So that's going to, that's going to flow up into this hard cost number here. And then really, you come up here, you put your loss factor in. So you put your residential. So residential gross square footage. So your residential gross square footage really incorporates your lobby, back of house, hallways, all of those things. So usually you want to see this around, you want it under 20%. If you're over 20%, it means you probably don't have a very efficient building, which means your costs per square foot are going to get really wacky. So you look to be, we're 17% here. So you look to be, under 20% or under is kind of the bogey we look at. So you put that in, and then come back down here and you kind of solve back to, we know roughly where our per unit costs should be, hard costs. So really it's kind of, see, this looks like a kind of weird number, right? 279.95. So we know we have a bid in our hands right now from a general contractor that we're going to build this project with, Snyder Building Group. We have a bid in our hand right now that's, right at this 310,000 a door number. So that's really what we're backing into. And initially, early phases of an underwriting project, right? You will go out and say, hey, here's a very high level diagram of what we're looking to build. Here are some assumptions to make on finishes. All right, general contractor. We'll go to multiple general contractors and then kind of average out the feedback that we get. So like I said earlier, right, it's one of those things where we continue to refine the more information that we get. But that's, this is the crux of it, right? Like you can see, usually your hard costs are about 80% of your overall costs. They could be more or less depending on how much your land is, but generally speaking, like hard costs, land costs, rents, and expenses. Those are the four categories that really can move a needle in underwriting a development deal.
Okay. I see a couple questions in here about like people are kind of like, wow, that is amazing high rent you got, even for Wash Park. Would you be able to share that? I think you said you did like a case study on how you achieved those rents at the Aston.
Yep.
Or
Yep.
Can you share that? We'll distribute with some people that are interested in kind of getting the detailed breakdown.
Yep, I am. I'm happy to share. It does seem high, but when you're looking at rents in Cherry Creek at $425 a square foot to $450 a square foot, now this seems like a deal, right? So we're always going to be behind those submarkets, but they continue to go up, and I hate to say it, but there's a little bit of downward pressure on rents right now. Because of concessions, and and I think, I just read an article, we're over 2% negative rent growth over the last year. We've been able to stay, while we're at the Aston, our year over year is static. So we have not taken, we've not seen the decrease, but, I hate to say it, but rents are going to continue going up in Denver. There's a supply glut going through right now. Once that gets absorbed, come 2026, 2027, we're delivering this project. I don't want to say it, but I think your average for crappy product is going to be at $4 a square foot pretty quick. Just due to people continuing to move here. We're absorbing everything we are, and Denver decided to put a really, really bad affordable housing mandate on all new developments, and you're just not going to see a whole heck of a lot of new development here going forward. So it does seem crazy high, but we got it across the street, and I should say too, Chris, is those rents. What I'd go back to is on the rents, right? You're really looking at your net effectives. So when you look at your net, it gets a little skewed because we are doing affordable here, right? So you can see the difference between the market rent and affordable rent. Like it's big.
50%.
It's 50%. Yep. So when people say this doesn't matter, developers will keep building. The only way you really can make sense of this stuff and incorporate affordable housing is to have high rents, and that's what's going to happen. I think in the marketplace, you're going to see rents go through the roof. And once they do that, then developers are going to come back in and say, I can make the numbers work again. So, the socialists on city council, I think, are going to be smacked in the face pretty hard when they, what they passed has the opposite effect, which everyone told them it would. But, they just say, well, developers are going to build no matter what. And that's just not true. We find markets that we can build in. Sub-markets we can build in, right? We're not going to leave Colorado, but Denver's become challenging. So you have to have kind of high rents to help offset this affordability factor. So, and the other thing I would say is the affordable rent here is the same affordable rent as you would have in a less desirable submarket, right? So if you're at let's call it 350 rents, here, right, we can help make up for it, right? You're over in a less desirable location and your rents are 275 a square foot. It's really hard to make that difference up.
Yeah. No, that's great, like market dynamic insights. And so that's what I want to talk about. You talk about, rents and everything. Yeah, we're in a soft spot in the market, but two things like about this deal is, hey, it's Wash Park, and hey, drive between Wash Park and Pop Park. Not quite as many trains as there are in Rhino, right? Like, there's just not a whole lot of trains.
Yeah. That's exactly right.
And the second thing too, which I think this comes down to underwriting, whether you guys are doing your own deal or reviewing another deal or a broker's perform on something, is Adam leans towards doing untrended assumptions or untrended rent rates, which means, hey, this is going to start running out in 2027. But we're going to use 2024, 25 rents that are real and not inflate it, which is a nice.
That's exactly right. So if you look here, right, and the question might come up, hey, like, why do I see 380 here and why do I see 351 over here? So this is an effective rent at the end of the day. So we're building concessions into our lease up. So that's why you see this number lower than you see it over here. These are our rents that we are getting today across the street, or across the highway. So, but we're saying these are the rents that we're going to get at delivery in 2027. So a lot of developers will bank on that rent growth while you're building. And you'll hear a trended yield versus an untrended yield. Our trended and our untrended are the same exact.
All right, so we got a hard cost. What's the next area you dive into?
Here goes right there. So then I'm going to go to financing. So then when you go to financing, this is construction loan details. We're going to actually beat this. We're talking with banks. We're talking with banks right now. And, our leverage might be a little lower, but our rate's going to be lower as well. There's some options for a little bit higher leverage. So we're going to be right in this area. So at that point in time, call your banker. Usually you can find online, but we have a lot of different relationships with banks, a lot of different brokers. So we're always constantly understanding what's out there. And I think we're going to land somewhere right around here, and depends if you sign recourse or don't take recourse. And that's recourse is basically personally guaranteeing the lease or the loan. So if there's losses, like they're going to, and they lose money on their loan, they're going to come after you. So you can get better terms if you're willing to take recourse versus not take recourse. So a lot of different things there. Below that, so we said 65% loan to cost. And then that kind of comes over here, right? So you can see 65%. And then you've got LPGP equity. So total equity is 10.8 million, loan of $20 million. Then you can go through, this is not pertinent in this underwriting. If you're looking at a long-term hold, we would look at refinancing out of the construction debt into long-term debt. We're assuming that we sell this in month 48. So, 4-year hold total. So that's why this doesn't come into play. We're just going to assume that the construction financing stays in place the entire time and then we sell. And then, you keep going. So this is where you set your development and construction management fee. This is an owner contingency here. So that's, when we say 5% of HC, that's a hard cost. So, so kind of where we're at right now, we'll always carry a 4% owner contingency. So that's basically our entire budget. we're taking a 4% contingency on. So you can see that here, $804,000. We'll keep that in the project. On top of that, there's a general contractor has a contingency in his $20.1 million number. And then within this $3.5 million, we've also got a soft cost contingency as well. So we like to go in with a lot of contingency. Nothing ever goes according to plan. And, there are always different things on different projects all the time that are missed or you have to be worked through or unknown. So we always like to have a heavy contingency. Development and CM fee, that's a cost to, that's a payment to the developer for really finding the deal, putting the deal together, putting the financing in place, finding investors, finding the bank, personally guaranteeing we usually personally guarantee the loans. There's a cost to that, so that equals, it's 5% of hard cost. And really how you should look at it is a percent of overall cost, but there's a circular reference. I don't know if anyone's ever done circular reference in Excel, but kind of a pain in the rear. I'm looking here, a typical cost, typical fee is 100 plus units. You're looking at, I'd say actually probably 125 plus units, you're looking at 3%. When you get below that, depending on size, returns of the deal, all those things, you typically see the 4 to 6% of that. So we're at 3.4, so we're really reasonable here. And this also pays for construction owner's rep as well that we bring into the project and oversight of the entire construction process. So
can you talk about what an owner's rep, what that role is?
Yeah, so an owner's rep is, we're on our team, we're mostly finance guys at the end of the day. So we're finance guys and not construction experts. So it's really someone that we bring in to oversee the general contractor, right? It's the developer's eyes and ears on the ground of a development while it's happening. And it's really just an accountability person, for the developer to the general contractor. They're pretty invaluable. And look, I'm not saying we don't know what we're doing. We know enough, but we don't know how to build a building, right? That's why we hire experts to do that. So really, they're looking out for the developer, and and in conjunction with that, all of our investors, right? So if you invest in this project with us, that owner's rep is really your eyes and ears that are on the ground, overseeing construction.
Great, thank you.
Yeah.
All right. So, got all this.
Yep. So then we get into development schedule. This has 12/1/23. This doesn't matter. Because really how this model is built is it's really built in fiscal years, not calendar years. So I can move this date out 3 years and it's not going to change any returns. Pre-construction period. So this is when, how long until you start construction. Construction period is 15 months. So that's the entire duration of your construction period. And I'll show you where that comes into play here in a second. And then you've got lease up period. So we've said, hey, we think this is going to take 8 months to lease up. We believe that we can come out of the ground. We believe that when we deliver, we can be 20% pre-leased, which isn't a crazy high number here. Stabilized occupancy, 95%. Where I mentioned the concession earlier. So a 4-week concession. So we'll burn that off. And then this is kind of just your annual rent growth going forward. So we tend to always just leave this at 3%. We don't try to match and get fancy with, reading publications and, it's 2, 2, 6, 8, 5, right? We just say 3%. And if we can outperform that, great. Going down here, this is our sale. This is our sale and deal month. So this is 48 months. So 4-year hold from start to sale. It potentially could be shorter. It could be longer. When the market's right, but we have to kind of make some base assumptions. So we say 4 years. That's enough time to build the project, stabilize the project, and then have a good stabilized NOI at sale. Sales expense 1%. That's pretty typical. We'll always try to negotiate that down. And then your exit cap and NOI. Exit cap. Your sale NOI just comes from the model based on all the assumptions that we've talked about. Which I'll get into expenses in a minute. But exit cap rate, right? That's the $1 million question that no one really knows what that's going to look like in 4 years. I can tell you, we like to be, if we think cap rates are going to come down, we'll match the current market. There's a most recent sale comp that just sold, and it was it was actually a little under a 4.25 exit cap. Sold for $620,000 over on South Tennyson Street, Lyric 39. So that makes me feel pretty good that, hey, like something just sold for a 4.25 cap rate, and we've got a 5 exit cap in here.
So yeah, this is kind of like rents, doing good rent study. The best you can forecast, an exit cap rate is so vital. Because hey, I actually want to make the project profitable. And so as a reminder, like, hey, the higher the cap rate we buy or build at, you can see the untrended return on cost, 6.27%. That's kind of like the basically the cap rate for building, right? That's how I think about it. So hey, we can build at a 6.3 cap rate and then sell at a 5-ish cap rate with upside, which means hey, the cap rate may compress more. So if you're able to zoom in a little bit more on there, Adam, on that that project exit window, that'd be, so if you look at here, you can see levered IRR projected to be 21.8%.
Yeah.
And that's at a 5% cap rate. Can you change that cap rate to 4.5?
Yep.
So this is good. If we're building this, we sell the lower cap rate, that's better for us.
Yeah.
And you see the IRR goes from what, 21 or 22 we said to like 30.
22 to 30. And then back when things were really trading, this probably would have traded right around here.
It would have traded in the 3s, huh? 3 and a 3.75.
My model can't even handle that. So, but if this goes, let's say it's a 4, right? There were some assets that were at 3.75. Which I mean, you can see. So where we're going with that is that there's a lot of, we think we've left a lot of upside. It's we want to be very realistic in where our assumptions at, and that's really what how we try to model it. And you could say, hey, your rents are aggressive. We don't think they are. We think they're very, I wouldn't say they're conservative. I think they're like middle of the road. And then when it kind of comes to your exit, when you come to your exit assumptions and things, that's where we try to tend to be a little more conservative. And this number, you might say, hey, this is per unit. This is a big number on a sale, right? You have to remember this is in 4 years. There was just a deal that's traded at 620 that isn't, I think, an inferior location and an inferior product that we're going to build. There's so in the package, in the investment memo, we've got the backup for all the sales comps and stuff. So I feel very comfortable with what we're showing here.
And I mean, this is where I like to do my own underwriting and see the underwriting and the type of investments I like to make, whether it's me doing it actively, like in the last market cycle, or investing alongside people like Adam and Narrate, is, hey, good underwriting, right? Hey, rents are at today's price. Exit cap rate is, a conservative today's rate. And then I'm going to take back over the screen sharing here, Adam.
Yeah.
And I'll kick it back over to you. But like something I'm very, big on right now is, the time of the market cycle. And this is where, hey, good numbers. Hey, if it's a 20 IRR, that's still like great number. It's like, I am happy, very happy with that. That beats the historical stock market. But we're going to be selling we'll be selling in this recovery phase, right? Probably this phase 1 recovery. Hey, we're down here in the recession phase right now, and probably starting to get into the recovery soon. Well, in 3, 4, 5 years, we'll be in this market, which is a prime time to sell and give us that ability to say, hey, if we, hey, the project, pretty much everything goes as planned. We take our few, lumps that you always do in any project, but hey, you got the contingencies built in there. And then we sell into a strong market. that's where we can see some exponential jumps for returns. Like, oh, wow, we've got some amazing tailwinds. If we get those, great. Extra 5, 10, 15% return. If not, hey, a baseline 20-ish return, I'm still very happy with. So like the base return, but there's a good potential for upside as well.
Yep. You nailed it.
So you can, I'll stop sharing on there, Adam. So you can go back to the spreadsheet. And Christy, you always
have one question.
You're like, yeah, what's the question? You're too quiet.
Yeah, so you're bringing your spreadsheet back up, Adam. I think, so one thing that was really new for me when I started investing in multifamily was the impact of concessions on the NOI.
Mm-hmm.
And so I know you kind of mentioned it, but could you just speak to that a little bit and how you attack your lease-up period and your rents? Impact that on the back end?
Yep. Obviously, it's always a balance, right? It's a balance between rents and occupancy. So what we tend to do is in all of our underwriting, we'll always have a concession built in, no question. Just in case we need that tool in order to be able to lease the project out. So that's really, really important. Really important for us. What we do on concessions, and they've jumped back in. We have our renter base at the Aston is very sophisticated. So they're negotiating on renewals like concessions right now. But we think we're going to see that go away. Once the supply gets scooped up. But that's the other thing is like you want momentum on a lease up, so concessions help you get that. But also, we could drop rents. We could drop rents and fill the building up very, very quickly. But if we plan on selling pretty quickly, then that hurts us, right? Because your NOI is really the driver of the value you can get on a sale. So if our business plan is to sell within 4 years, we're gonna take a slower, we're gonna take a little longer to lease up and try to hold those rates in order to get as high a sales value as we can. The other thing we do is when we do concessions is we make residents take them up front. So we don't amortize that 1 month of free rent into the entire lease term. They get literally 1 month free where they don't pay rent, and then they're going to pay market rent. So so the reason we do that is on a renewal, if we try to bump rent and you amortize that concession into 12 months, it's going to be a bigger jump for them than if they, hey, take your 1 month out free, take your one month free up front, and then now you're paying market rent for 11 months. So it's a psychological game a little bit, but that's how we always.
That's interesting. I did not know that. That's interesting how that plays into it.
Yeah. So it's a really interesting way to think about it, and so think because if you do the math on it, I think a 1 month concession is about 12% of your rental rate typically. So imagine after year one and you increase it 12% per month, and then you try to do an increase on top of that. That's a lot, right? So that's why we're trying to get them used to paying that true market rent. Net effective for us, it's the same. For the resident, they're paying the same. It's just a difference of how they make their payments.
Okay, and do we have time for one more question, Chris?
Sure.
Okay, so I did have one other question. So you mentioned up front, and I knew this about this deal going into it, which was great, the covered land play piece of it. So for me, when I'm thinking about developing, a duplex or a house or something like that backing into that land valuation is so critical. But can you talk about how the covered land play in this case impacted the deal structure, so that you're going to be bringing some income from that? Was that meaning that you were willing to pay a higher amount for the property? Does it where does that come in?
Yeah. So you hit the nail on the head. So there's a couple, right. There's a couple reasons. So yes, the short answer is yes, you can pay more for land if it's covered land play. And the reason being is if you have no revenue to during that time period, right, an existing property does have expenses. So ultimately, you have to capitalize those expenses. You've got taxes, insurance, you've got maintenance, all of those things that you know, even if it's a vacant piece of dirt, right? You still have to maintain the property. You still have to have you still have to pay taxes. You still have to have insurance. So if you don't have a covered land play, you have to capitalize. You have to capitalize that into the deal. So the other, so that's number one. Number two is, you know, by having an existing 20 units here on site, that, you know, we actually bought it at a 5 cap, which, you know, on the existing NOI, which, you know, we wouldn't buy in today's market, but you know, when even when we bought it, not in that day's market, but 2 years ago, a 5 cap, people would have bought all day. So we actually bought it at a pretty good basis. But by having cash flow at the property, it affected how we financed the deal at acquisition. So rather than coming out of pocket for, you know, $4.125 million in equity to buy the land plus X amount of dollars, plus X amount of dollars on top of that, you know, we were able to get a loan. You know, so which reduced the amount of equity we had to raise for the project, which is you know, land equity is you know, challenging to raise in today's market. So the less of it you have to do, the better.
Cool. Thank you.
This is great, Adam. I got one more question for you.
Yeah.
Hey, this is going to sell, you know, for $40 million, maybe more, depending on the, you know, where the cap rate trades at, but $40 million asset, give or take a few million.
Yep.
Who's the buyer for this?
That's a great question. And we, you know, originally when we did the estimate, we weren't sure. We're like, hey, it's a little too big for a single investor, but it's too small for an institution. What we found is that you attract buyers of both. So on the Aston, we were actually under contract to go to sell it upon TCO completion. It was kind of when interest rates were going up, so buyer walked away actually from earnest money as well. I still think they should have bought it because they were buying it all cash. But
was this an institution or a solo investor?
This was an institution. But we had unsolicited offers from high net worth individuals as well. We had some 1031 guys looking at it. You know, we went with the institution because we actually thought it gave us the highest probability to actually execute the deal, which turned out to be false. But you know, you really get you know, you might think of it as a tuner, but when you have a quality asset in a quality location, institutions are willing to you know, to come down the scale a little bit. From a size perspective, and you know, I think high net worth individual family offices, it kind of fits right in that sweet spot. You know, so at the end of the day, right, you're looking at you know, call it probably 10 million in equity, roughly. You know, by the time you put an acquisition loan on it, in a normal environment. So I think you know, which is a lot of money, but you know, for someone that has a lot of money, it's not. So, you know, so I actually think with the quality of building we're building here, and the location that we're building, we open ourselves up to a pool of additional investors.
Yeah, it's a very, very unique asset and a great location with limited supply. I mean, I can't wait till I'm like solo investor stroking a $10 million check for project one day. That is awesome. But if you guys, I know we're running out of time. We got some questions here. Drop in the chat box for Christy. We'll go to you. You've got one more. I do want to wrap up or put one more thing on radar here. Actually, two things. One is I'll drop this link now, but I've had some people interested in just say more of the underwriting on here and more of the overall deal. So this is the data we put together for actually this deal, but also the deal I invested in, and Christy, a lot of investors as well. It's actually a 3-pack Colorado Multifamily Fund. So it's this site here in Wash Park, and then 2 sites in Colorado Springs. And those are actually 2 we're underwriting the next few weeks on here. So if you want just more details on either as an interested investor to see how things are structured, feel free to check out this deal room. It is packed full of information, along with assumptions, other stuff as well. But if you're interested in investing or seeing how people like Adam structure these deals, it is a gold mine, plus a lot of other data in here on this project. And the other thing I want to bring everyone's attention to is we're doing our second webinar, February 6th. And this will be on Canopy, which is the 183 unit in Colorado Springs. This is another investment in that 3-pack fund. So underwrite that project and also talk more about the Springs market. You know, a lot of similarities, but there are some differences. The other thing I'll put on the radar, we've had lots of people interested over the years in 1031 exchanges into bigger deals like this. Can't really do a 1031 exchange into deals like this, but a qualified opportunity zone. It has a lot of similar tax benefits to 1031. This deal, we'll talk about how that can work. So if you're interested in the fund in general or the underwriting or potentially investments in 1031 type investments, come learn about that. And then we're actually doing a bus tour as well for this project and another project Narrate is doing. We got a 50-person charter bus, February 20th. We're visiting this site here in Wash Park, then the 2 in Springs, and the 3rd, another deal that Narrate Adam has down there. So it'll be a great way to learn about it. We are about 56% filled though. So if you're interested, let us know. And we are really, prioritizing people interested in QOZs or investments in here. But please come learn how deals are done or learn more about this as well. Christy, what final questions you got there?
Yeah, so I think you didn't really talk about it in here. Maybe this is something we can even talk about more on the next deal analysis. But this is a mixed-use building, right? I think you have some commercial space down below. So just
this one's
love
actually
to hear how that plays in.
Yeah, we'll get into that on the next one. So this site's actually all residential. So
that's right. This one is.
We've got on level 1. We don't think it's a great retail site, to be honest with you. We can do retail here if we want. But ultimately we don't feel like it's a great retail location. So we actually created these like cool walkout units, great for dog owners that have little stoops. But yeah, we could get the next project we're going to talk about does have a retail component to it. So we can, we'll take a dive into that and what does that look like and how does that kind of incorporate into the underwriting here?
Fantastic. Great. Well, Adam, thank you so much, man. I know you got a lot of meetings on your calendar, so I appreciate you taking the time and always appreciate spreadsheet time with you.
Yeah.
So thank you. I every time I do this, I always learn like 1 or 2 more nuggets. So thank you. I'm excited to invest in this deal. I think Christy has got a lot of people here just saying thank you in the comments for diving and their interest. If you guys have any questions on the bus tour, interest in that fund or one of these assets as an individual, let us know. We'll send you all the details. If you want to just learn more about investing in general, plug in and do some site tours and bus tours as well. But we're here to educate. And then when everything makes sense for everyone, here to do deals as well. So thanks, everyone. And Christy, thanks for hopping on last minute to co-host with me.
Yeah, thanks for having me. Thanks so much, Adam. It's always good to have to say about these things.
Yeah. I always enjoy. I guess it was me doing a lot of talking, but always enjoy getting together with you guys and talking deals. It's one of my passions. So
awesome. Well, thanks, Adam. Thanks, Christy, and thanks everyone out there. We'll see you for the next deal show soon.
All right. Bye-bye.